ანუ ისმის უკვე ჩვენ.
Yeah.
მოგესალმებით, პატრიცემულო საზოგადოება.
Good afternoon, dear guests, dear colleagues. We have a very good news for everyone. For IASB representative will inform us about the news which are planned regarding the standards, the projects, and management reporting. He will talk also about management reporting, and Today's event is supported by the World Bank. We have a World Bank representative here at our event, and he will greet the participants and also inform you about the new things. I will not talk a lot. I'll just give you some technical information. For those who prefer to listen to the presentation in Georgian, has to choose German. Unfortunately, Georgian is not in the list, but you will be able to listen to the presentation in Georgian. Once again, I am happy that so many people are present at our today's event, and wish you a successful day. Now I'll give floor to Evgeny.
Good morning, David. Good morning, Tadeu. Good morning, everyone. At the start, let me just check if you can hear me well.
We can hear you.
Excellent, thank you. Also, a big apology for that Mr. Sebastian Molineus, the regional director of the World Bank for the South Caucasus, was not able to address you today. We have the visit of our regional vice president, and they're traveling now to Azerbaijan for meetings with the government representatives over there. But he passes on his regards. He has been very eager and great supporter of this agenda, and you've seen him on previous events like this, and I'm sure you'll see him in the next ones you are organizing. Next, I would really want to welcome everyone to this session in which we will hear from Mr. Sendon about the annual updates from the International Accounting Standards Board. IFRS are the world's most widely applied accounting standards. In fact, today, majority of the countries around the world, including Georgia there, have transitioned to the IFRS. And there is no doubt about the importance of accurate financial reporting and auditing standards. Investors, stakeholders, governments, they all need accessible and usable information to make decisions that can ultimately support innovation, investment, and growth. There is no doubt, and there is plenty of empirical evidence that links level of investment in the country with the quality and availability of financial information. If anybody is not persuaded by that empirical research, there are also plenty of evidence from the other side. We have many clear cases where insufficient or poor financial information has had negative effects on employment, the investment climate, and public finances. But financial reporting standards and practices are continuously evolving, aiming for increasing rigor, harmonization, and transparency. This means that events like today's are important to understand firsthand about the changes to the standards and to help preparers of financial statements prepare more quality reports. This probably gets an even greater importance in the current environment. The COVID-19 pandemic has disrupted life around the world and in Georgia too. But businesses have adjusted, and a lot of them in quite innovative and different from before are continuing to work. So companies have and will continue to report on their operations, financial conditions, and cash flows during and after the crisis, and those reports will have to be audited. In many ways, this reporting and auditing is even more important during a crisis period than during normal times. Georgia is establishing a strong track record in adopting and implementing EU standards in many areas, including in business reporting and auditing, and developing conditions in which businesses can thrive. We at the World Bank are proud to have been Georgia's partner in adopting and implementing important reforms in the past few years, aimed at increasing business transparency and improving reporting practices. These reforms were spearheaded by SARAS and were done in cooperation with international organizations such as the EU and IASB. These changes and institutional reforms are fundamental to improve the quality of financial reporting, which in turn helps to achieve greater company transparency and accountability, improves investor confidence, and thus contributes to economic growth. We would like to congratulate SARAS for leading this reform and making a significant effort in raising the business's capacity for application of the standards. We would also like to genuinely congratulate the Georgian business community for embracing the reform and striving for better quality reporting and transparency. The audience at this event is really telling about the commitment of the enterprise sector to this. Jointly with the European Union, we at the World Bank Group will continue supporting the ongoing financial reporting and audit reforms in Georgia, and will work with SARAS and wider stakeholders in their remarkable journey in this area. We are proud that Georgia has taken a leading role in this reform in the region and provides an inspiration for other countries in the EU Eastern Partnership. Finally, once again, thanks to Mr. Sendon for devoting his time today to present to the Georgian business community and update you on recent developments. We hope that the workshop will be useful and interactive. Thank you very much and have a great morning.
Thank you, Evgeny, for these great words. Madloba baton Evgeny am saჭირო სიტყვებისთვის.
We would like to thank Evgeny for this introduction and for the support provided by the World Bank to Georgia and our reform. There are many questions in chat. Please don't write the questions in chat. You have a Q&A button and write your questions there. And if you write them in Georgian, we will try to translate your questions to Tadeu. Tadeu, please, the floor is yours. Thank you for being here with us.
Thank the World Bank and SARAS for having me today. It is a pleasure to be here with my colleagues from Georgia, and congratulations for the event and for all efforts for improving the quality of the financial reports in the country. My presentation today will be divided into two parts. The first part, I will present an overview of the current projects we have here in the IASB, International Account Standard Board agenda. And then I will pause for any questions that you might have. And then we, in the second part, advance for providing details about one project, that's management commentary. Okay. What we have in the agenda for the first part, I will start with the documents open for comments and forthcoming consultations. After that, I will describe the documents that are in the what we call redeliberation phase. I'll explain that one. And also I will touch on other projects, the work of the interpretation committee, and finally talk about some, we have two projects on strategy and governance, and I think that it will be of your interest. Okay, starting with the consultation documents open for comment. Here you can have a very good idea of the comment period for documents open for comment, or that are about to be released for comment. There are the ones that are ready. They are standard setting projects, I would say, that issuing standard. It means that usually they are big projects. The other projects, especially the two in the bottom, they are maintenance projects. It means that is a very targeted improvement or change in the standard. And the post-implementation review, it is an investigation process that will or may not actually generate any amendment. But I will explain when I start going into the details about each of them. And it's starting with the disclosure requirements. This document or project may actually be divided into two parts. The first part, it doesn't change the standard itself, any standard actually, it is a proposed guidance to help the board to develop and draft disclosure requirements. This is basically to incentivize companies to apply materiality judgment to decide what to disclose instead of applying the famous requirements like a checklist or as it is very common, just checking there whether the information is there or not without actually making any assessment about materiality. The second part of the document is to show in practice the effect of applying this new approach. What we have done, we created this guidance about how we should from now on write or draft the disclosure requirements, and then we are testing, let's say, that's why I call pilot approach as well, this project. We are testing this on two standards, IAS 19, employee benefits, and IFRS 13, fair value management, to show how the disclosure requirements would look like applying this new approach. This second part means changing the standard. The second part, again, is just a guidance. The first part is just a guidance. The second part is effectively change in the standard, applying the guidance that I mentioned. The main idea here, as I said, to make companies comply with disclosure objectives, applying judgment. These disclosure objectives would come along with explanation of what investors may do with the information provided, and would be linked with what we call items of information that, in the end of the day, are examples of disclosures that could help management to meet the disclosure objective. It is a list of examples, not a prescriptive list of requirements, but it is likely that some or many of these examples, disclosure examples, you will need to include if you want, or actually you have to meet the disclosure objective. Therefore, it is examples, but at the same time, it's just not trying to behave as if this is a prescriptive list. It actually to stimulate management to make a decision about what would be the best way to meet the disclosure objective. It is really trying to incentivize management to exercise judgment. The comment period ends in January 2022. It's a quite important project because it will have effect in the way that from now on we would draft the disclosure requirements. Therefore, it's not just IAS 19 and IFRS 13. It might have impact in the way that we do it from now on, new projects or every time that we review a new standard. This second one, that's management commentary, as we are going to have a session after that, where I will provide more details. I'm not going to explain details this one, but it's just one project that related to the update of what we call IFRS practice statement. But again, as I said, I will provide more details after this presentation about the update. Disclosure initiative subsidies without public accountability. Actually, these projects affect companies that, in the end of the day, meet the definition of small and medium entities. But at the same time, these companies are subsidiaries of companies that use full IFRS. As they are subsidiaries of companies that use full IFRS, they end up having to use IFRS, or if they use another GAAP, for example, IFRS for SME or Georgian GAAP, they will have to keep track of the difference between these two GAPs, the IFRS full and the other GAAP that the company is using, and they will need to send the information for consolidation in preparing for local purpose. The proposal is to allow them to use IFRS full, but have a disclosure requirement similar to that of an SME, a small and medium entity. It would reduce the cost of preparing the financial statement, and at the same time would maintain their usefulness considering the profile of the entity's users. An important point to note is that this standard is a voluntary standard. Therefore, it doesn't mean that a company needs to apply if they are applying. If it is a subsidiary that is an SME, they decide to apply for IFRS, they are not obliged to have this reduced disclosure. They can apply the other standard normally. It is optional, but it needs to meet some criteria to be eligible to apply this one. Even if a company is in the scope of this standard, again, it might decide not to apply it, or actually some jurisdiction applying IFRS may decide not to allow these subsidiaries to apply it. Therefore, the fact that a country doesn't allow companies in their jurisdiction to apply this standard, it doesn't mean that this is not compliant with IFRS, because it is an optional standard. Therefore, if you decide not applying this one in your jurisdiction, you are still compliant with IFRS. The comment period ends on 31st January 2022. Post-implementation review of IFRS 9. Here in the IASB, we have a due process handbook with the requirement for a post-implementation review of new IFRS standards or major amendments. This has to be carried out 2 to 3 years after their implementation. This is what we call post-implementation review. The objective is to assess whether these standards or amendments are working as planned, and if necessary, to propose adjustment. And again, if necessary, propose adjustment. Not necessarily post-implementation review will give rise to adjustment to the standards. Having said that, this specific project is about IFRS 9. It's the post-implementation review of IFRS 9. That's the standard on financial instrument, but at this moment, limited to the classification and measurement requirements. The post-implementation review for impairment and hedge accounting requirements will be carried out in a later phase. Actually, yesterday, we are in the middle of our board meeting, and yesterday we have just decided that the impairment part the post-implementation review of the ECL that we call, or impairment part, will be probably starting in the second half of 2022. And in the second half of 2022, we'll decide when the hedge accounting requirements, the phase on hedge accounting requirements will start. The document, this first part that's just about classification and measurement, is open for comment. The document that collects the information about how is the standard working is called Request for Information. 6 view on the areas such as business model, the concept of SPPI, that's solely payment of principal and interest, fair value change in equity, and other topics that are only related to classification and measurement. The comment period ends in January 2022. Forthcoming consultations, these are projects about to be issued, actually probably by the end of this month. The first one is a narrow scope project on supplier finance arrangements. These arrangements have been in the radar of investors, regulators for some years. They say that they are not always able to understand the use and effect of these arrangements in the entities. Sometimes it is difficult to compare the entities, and also it may not make clear the total amount of an entity's borrowing, because you just change what would be a supplier, accounts payable, and actually you don't realize that it just becomes part of the borrowings, the total borrowings for the company. Therefore, the proposal at this moment is not change the classification, it's just about disclosure. It doesn't definitely touch on measurement as well. It is basically to add some, for these transactions, some qualitative and quantitative disclosure requirements to IAS 7, that is the standard on cash flows, and add wording to the existing disclosure requirements in IFRS 7, especially to draw attention to some existing required disclosure, especially related to liquidity risk. The exposure draft, as I said, might probably be issued by the end of this month. It's ready, but we have some internal process here, but probably in 1 week or two, we will be out for comment. The second project in the pipeline is non-current liabilities with covenants. Here is its classification of debt. This project is actually trying to adjust amendments that we made in IAS-1 and were approved in 2020 as part of the feedback received. By the way, this amendment has not entered into force yet, but before it entered into force, we got some feedback after the publication of the document, especially our interpretation committee that became aware of some outcomes, potential consequences of applying the amendments. And this feedback provided some, let's say, additional information that we haven't considered when developing the amendments. And then therefore, the project is to propose amendments to the amendments before it comes into force, to specify that conditions with which an entity must comply after the reporting period do not affect classification of a liability as current or non-current at the end of the reporting period. Just to give an example, if your year end is 31st December and you have to test a covenant, let's say 31st March, what was proposed in 2020 is that if in 31st December you haven't met the covenants, you would need to reclassify, even if the test is in March. Why that? Because March would be 3 months after the reporting period. And then it means that you are not able to avoid a reclassification of the payment, for example, if it is required immediately before 12 months. That's the rationale behind the amendment that we approved in 2020. But having said that and receiving some feedback, in the end of the day, if we're just looking at 31st December, because it will be tested just in March, it actually doesn't affect the 31st December classification. But what we have done, and actually we will propose, is to improve the disclosure, to draw attention to the fact that even if it is classified as non-current, because it has a test in March and it may not pass the test and may be required to be paid immediately, you would need to disclose this fact, draw attention to the readers of the financial statements. That's basically what we are trying to do here. And again, this also might be issued by the end of this month for comments. Redeliberations, these are related, are documents that are related. They were open for comment. We received the comments, and now we are discussing what to do about this project based on the feedback received. As you can see here, we have that we call internal agenda, because actually we sent these for comments for our stakeholders. We got it back, and now it's in our, let's say, field to decide what to do based on the feedback received. Starting with the first one, that we are in the redeliberation process, primary financial statements. This project is about a new IFRS standard that will replace IAS-1, that's the presentation of financial statements. It will keep most of the text that we currently have today in IAS-1. The changes are basically focused on income statement, and the main objective is to improve communication of making financial statements better based on the feedback we received in terms of some issues that are in the, especially users, also some preparers, but how the income statement is presented today. It is a big project. We are currently discussing the feedback received. Actually, every month when we have our board meeting, there is always papers on this project. Is a really big one. The proposal will bring some defined subtotals to the income statement, try to work better the concept of aggregation and disaggregation, and discuss the presentation of the income statement by function or by nature. And finally, it also proposed to bring into the financial statements some non-GAAP measures that we call management performance measures, to bring a little more discipline and transparency to something that the market commonly used to communicate, management communicate with the market. And as I said, this is a very big project, and we have been discussing the aspects of the proposals almost every board meeting, as I said, and then it means that it will take some time until we get the final decisions and publish a final document. When I say publish a final document, because in the re-deliberation, we have documents in different phases. Sometimes the next document will be a final standard. Sometimes the document that were out for comment was an investigation phase, for example, discussion paper. It may generate an exposure draft that in the end of the day will generate a standard. Therefore, it's different phases. This one specifically, it was an exposure draft, and then the next step, if everything goes right, okay, it will be a new standard. Second review of IFRS for SMEs, small and medium entities. From time to time, this standard needs to be reviewed. The original standard was issued in 2009. The last review was in 2015, and now we are in our second review. The starting point is still the full IFRS, but following the criteria of relevance, simplification, and faithful representation that is applicable to small and medium entities when the alignment is made. As this is a comprehensive review of many different sections of the standard, I believe it will also take some board meetings to cover all of them, and we are able to issue an exposure draft. The first phase was a request for information, a kind of investigation or gathering information. And next document will be an exposure draft. Goodwill impairment. This project is a response to the post-implementation review of the IFRS 3, the Standard on Business Combination. We have issued a discussion paper with some proposals to improve the information about acquisitions, especially about the subsequent performance of the acquired business. Also, this project brings some simplification in the goodwill impairment test. It mainly brings to the debate whether goodwill amortization should be reintroduced or whether the current annual impairment test model should be maintained. We have been discussing this project in the last board meeting, and at this moment, we are focusing on the preliminary views on the package of disclosure requirements before moving to the other aspects of the proposal, including the amortization of goodwill or not. Lease liability in a sale and leaseback transaction. IFRS 16, the standard on leases, came into effect in 2019. It's quite recent, its application. We identified the need to include guidance on the measurement of lease liabilities when we have a sale and leaseback transaction, especially when the leaseback provides for variable payments. This project is basically to introduce guidance to deal with this matter, and we are going to discuss the project direction in our next month, in our December meeting. Post-implementation review of IFRS 10, 11, and 12. This project is the post-implementation review of the standards on what we call group reporting. IFRS 10 is on consolidation, 11 on joint arrangements, and 12 on disclosure of interest in other entities. As any other post-implementation review, the objective is to assess whether these standards are working as planned, and if so, propose some adjustment. We started discussing the feedback received. In our October meeting, based on it, we concluded that the three standards are working as intended. Notwithstanding this conclusion, we also decided that as part of the third agenda consultation, we will consider some specific topics raised in the post-implementation review. For example, investment entities, collaborative arrangement. It's just a coincidence that we just ended. We are in this phase of the post-implementation review, and we are also dealing with the agenda consultation. Because usually we would deal with the results of the post-implementation review as a standalone project. But because we are having so many decisions to be made in relation to our working plan, I'll explain after that about agenda consultation. And we have to decide together the results of the post-implementation review with our agenda consultation because actually it affects our resources and our work plan for the next 5 years. Again, we are literally in the middle of our November board meeting, and then therefore probably soon you have a summary of our decision, but basically that is the paper that we received this week. We just asked the staff to provide a bit more details before we make a decision what to do with the results. Sufficient work has been completed to conclude the post-implementation review, but because there is this pending issue on the papers presented this week, it is likely that only the next week we will close the post-implementation review and start to work with the projects that were recommended by the staff. Rate-regulated activities, as the name implies, this project affects companies operating in the regulated tariff segment. It could be energy, water, gas, possibly other segments, especially but not limited to concession arrangements, depending on the case. The project is about making some match of special revenue due to some accounting definitions. Some of the tariffs difference that are transferred to the following years end up not being recognized in the company's financial statements in that year. It means that if you are an energy company, sometimes you may have a difference that you are not allowed to charge your clients in the current year, but you will include this in the tariff in the next year, but actually it is a revenue for the first year. But because the way that IFRS 15 works, you wouldn't recognize this revenue in the year one, only in year two. What this project is about trying to bring this revenue to the year actually the difference is generated. But it will not be classified as revenue together with revenue IFRS 15. It would be revenue IFRS 15, and then you would have this regulatory income. And then again, it's all about recognizing these regulatory difference, regulatory assets, liabilities, revenues, and expenses. This Monday, the staff presented, this Monday, literally this week, as part of the summary of the feedback received, and the final part actually, because last month we started discussing this one, and from the next month, December, we may start making decisions based on the feedback. Business combination under common control. This type of transactions is outside the scope of our standard on business combination, IFRS 3. There is no guidance on how to recognize it. It gives rise to diversity in accounting treatments, and the discussion paper issued some proposals, some solutions. Depending on the feedback, they should give rise to change in the standard on business combination to provide guidance on this type of transaction. The main idea is to develop principles to help to determine which method to use. In some cases, a acquisition method, in other cases, a book value method. It will depend very much on it, and especially whether there is non-controlling interest in the receiving company. But actually, this is something that probably we'll start discussing the feedback in the next month. Lack of exchangeability. This exposure draft proposed to add requirements to IAS 21. That is the standard on foreign exchange effects related to situations where there is a lack of exchangeability. The proposed amendment would define exchangeability and thus a lack of exchangeability, and specify how an entity determines the spot exchange rate when a currency lacks exchangeability. And then just to give you a practical example, we are experiencing in some periods of the year exactly this problem in Venezuela. Sometimes there is no way to determine what would be the exchange rate. And then if you determine there is a lack of exchangeability, you should determine what would be the exchange rate to be used in the financial statement. That this project is all about. We must start discussing this in our January board meeting. Initial application of IFRS 16, the exposure draft is related to a proposed narrow scope amendment to the transition requirements in IFRS 17. IFRS 17, that is on insurance contracts entering into force in 2023, but actually this through the implementation process, we realized that we could include this option to enable companies to increase the usefulness of comparative information presented on initial application of IFRS 17 together with IFRS 9. I think that's a very welcome proposal for the insurance. We have already got the feedback, we discussed it, we have already approved, and the final document must be issued by the end of this month. Okay, here you have other projects in our working plan that will likely result in a future document for consultation. Let's start with the FICE, that's financial instruments with characteristics of equity. The overall objective of this project is to make minor change to IAS 32 on the presentation of financial instruments. The objective is to address the common accounting challenges that arise in practice when applying this standard. And how we intend to do that, actually clarifying some principles in the standard and adding application guidance to facilitate consistent application of those principles, in addition to developing some more presentation disclosure requirements, but without making fundamental changes to IAS 32 and causing a disruption in the market. That was the main feedback that we received in our discussion paper issued in 2018. We have been following the plan and discussing the practical issues over this year, and likely at least in the first half of 2022, we have been to issue an exposure draft. Dynamic risk management, this is the macro hedge project. The board is exploring whether it can develop an accounting model that will enable investors to understand a company's dynamic risk management and to evaluate the effectiveness of that risk management. This is basically for banks, and we gather stakeholders' views, especially banks, on preliminary core model. We are considering the challenges identified during meetings with preparers, and we are currently discussing some potential refinements to the proposal model before moving forward. Provisions, this project is related to the proposed targeted improvement to IAS 37, the standard on provisions, contingent liability, and contingent assets. This would involve aligning the liability definition and requirements for identifying them with our conceptual framework that was updated in 2018. Also clarify which costs to include in these provisions and specify whether the rate at which an entity discounts provision should reflect the entity's own credit risk. Basically, these three changes to be incorporated. Equity method, this is a project on IAS 28, the standard on investment in associates in joint ventures. We are undertaking research to assess whether application questions with the equity method as set out in the standard can be addressed by identifying explained principles in the standard itself. If you just look at the application of the equity method in different countries, people have different views. I mean, that we are just trying to see whether we can get some clarifications about the principles in the standard. But sometimes we can identify the underlying principle in IAS 28, but also we are studying how to develop additional principles to guide when none of these underlying principles would apply, specifically to the practical question. Last month, we asked the staff to research the implications of difference between principles in IAS 28 and those in other standards, especially on business combination and consolidation, IFRS 3 and IFRS 10, before we consider the application questions, just to be consistent between these standards. Pension benefits that depend on asset returns. In this research project, the board was gathering evidence to help decide whether to develop proposals to make a narrow scope amendment for IAS 19. At the end of the day, this is one of another issue that is all related to hybrid plans. When IAS 19 was originally developed, it basically treated, it's a kind of binary situation. You have defined benefit plan or defined contribution plan. And the problem is that nowadays we have many plans that are in the middle, what it's a hybrid. And then we decided that we shouldn't address this question specifically because we believe that we should do something bigger in terms of addressing hybrid plans. And then we considered to stop actually this project, and further work on pension benefit as a whole would be part of the third agenda consultation. Extractive activities. This project was a research project to assess whether we should develop proposals to replace the IFRS 16, that they standard on exploration for and evaluation of mineral resources. And after a very good, thorough investigation from our staff, in our meeting in September, we tentatively decided that the scope and objectives of the project should basically be to develop requirements or guidance to improve the objectives and disclosure requirements in the standard, and also remove the temporary status of the standard. No fundamental change of the standard, as it was the feedback and information we were able to gather. Now let's summarize the work of our interpretation committee for this year. The IFRIC is one of the most important tools for supporting consistent application of IFRS standards. They met 5 times this year. There will be another one by the end of this month. So far, they have discussed 14 topics. 11 of them gave rise to what we call agenda decisions. That is a summary of what was the view of the committee. Based on the current text of the standard, it means it doesn't change the standard or make interpretation. It's just the reading of the standard as it is. There is one topic that is still under discussion, and 2 other topics the IFRIC decided to recommend the board to be addressed via a narrow scope amendment. In this slide here, just for illustrative purpose, a sample of recent agenda decisions. Just remind you that since August 2020, when the due process handbook was reviewed, if an accounting practice is not aligned with an agenda decision, then it is not IFRS. This is something that was issued in August 2020 to clarify the enforcement of an agenda decision. These agenda decisions, we were actually, since last month, we start reviewing the process of the translation, because we just realized that some of them are not arriving in different countries being translated. And then we are just communicating with the different jurisdictions when they translate the IFRSs into their language, that these agenda decisions will also be part of the process of the translation. The difference is that in some countries, the translation of the IFRS, you have some royalties and etc. But in the case of the agenda decision, they should be available for free. You just have to agree how to translate this. And actually, the agenda decisions are available in our website without the need of a subscription. Now let's talk about the strategy and governance project. We have two at this moment. The first one is the third agenda consultation. I touched on this agenda consultation many times during my presentation. This is the most formal document we have here in the IASB to get stakeholder confirmation on what to add to our work plan over the next 5 years. It also discusses strategic direction, issues to prioritize. For example, we have a distribution of our time or resources between projects on new standards or new amendments, projects on maintenance, digital reporting, projects on educational material. We have a IFRS for SME. We have different activities. We also asked in this document whether we should rebalance the current allocation of resources between these projects, these activities. But also we asked for some of the stakeholders to tell us what would be the priority of some of these projects. That it's a list of 22 projects, that most common issues that come to us, especially through the interpretation committee, whether the stakeholders believe that we should work we should include this as part of our agenda, our work plan for the next 5 years. And then the document was a request for information asking the priority for these 22 projects, whether you believe it's a high priority, medium priority, or low priority. We already finished the comment period in September. We got the results, and last Monday we discussed the preliminary results of this request for information. And I can tell you the main, the best sellers, the main topics that appeared as high priority was climate-related risks, cryptocurrencies and related transactions, going concern, intangible assets, statement of cash flow. Not necessarily because I started with climate-related risk, this is the most important. It's just a list without picking up what's the most important. It's just to tell you that these 5 appeared as the priority for most of our stakeholders. And then for the next 6 months, we probably will decide and incorporate this to our work plan for the next 5 years. The second project on strategy and governance is sustainability report. During the COP26, if some of you have opportunity to follow that one, the chair of the trustees of the IFRS Foundation, Erkki Liikkenin, he provided an update on the proposed new board, that's the International Sustainability Standard Board, or IASB. This was an initiative of the trustees of the IFRS Foundation, who have since last year, November, been working to address the increased demand for sustainability reporting. This new board is being created within the foundation's governance structure. There is a commitment from many, because we have today many sustainability disclosure organizations, and then there is a commitment to consolidate into this new board. And with that, the IFRS Foundation will complete the consolidation of 2 other related organizations, the Climate Disclosure Standards Board, or CDSB, and the Value Reporting Foundation, the VRF, actually that it houses the Integrated Reporting Framework and the SARAS-ма standards. And probably this consolidation with these organizations into this IASB will happen by June 2022. While the IASB will keep issuing the IFRS accounting standards, the new board will develop IFRS sustainability disclosure standards to meet what we call the investors' information need in this area. These 2 boards will be independent, and their standards will complement each other to provide what we call comprehensive information for investors and other providers of capital. The new board will be based in Frankfurt, in Germany, where there will be the office of the chair, and together with Montreal in Canada, these 2 cities will be responsible for key functions supporting the new board. The IFRS Foundation will engage without delay with these 2 cities to make the necessary arrangements to enable this board, IASB, to commence work early next year. There will be also offices in San Francisco and London, and this is because some of the organizations that are being consolidated into this new board are located in these 2 cities, and then we already can count on the resources that these organizations have. I mean, that we are not actually using the current resources that we have for the IASB. Actually, we are trying to work and leverage on the staff that is currently working for these organizations that are being consolidated in the IASB. And again, these 2 cities, especially San Francisco and London, is more due to this integration process to these organizations. And there are also talks about having offices in Beijing and Tokyo. Well, this is a slide that usually we present to show how is the process of these sustainability reporting standards. And I keep this slide with the timeline of the project to give an idea how quickly it moved despite the size of this project. The first consultation, as I said, I think that was issued in November to confirm the demand whether the IFRS Foundation should play a role in the development of standards on sustainability disclosure. We got a very positive feedback that yes, we should try to do that, and recognizing the urgency of the matter, and in order to allow the new board a quality, let's say, running start, the trustees created the Technical Readiness Working Group, the TRWG, comprising representatives from the CDSB, TCFB, IASB, VRF, World Economic Forum, all supported by the IOSCO. This group was created to provide recommendations to the new board. I mean that while you have the process to establish the new board, there was another group already working with documents that would be issued by this group. And then this group has concluded, this working group has concluded its work on two prototype documents that were published together with the announcement by ERCI about the creation of the IASB. One document is focusing on climate-related disclosure that builds on what we have today in the TCFD, is already a framework that is used by some companies. And a second document is a set of general sustainability disclosures. It's just as a comparison, it's like a IS1, but for sustainability standards. Then these two prototypes will allow the board, the IASB, to quickly issue these new two standards, sustainability disclosure standards, based on these two prototypes. It is kind of almost ready, nearly final draft of what would be the new standard. These prototypes were already published and are available in our website. Okay, with that, David, I think that we can pause and see whether anyone have any question about the IFRS work plan, and before I start talking about this specific project on management committee.
Thank you, Tadeu. Actually, there are a couple of questions. Two of them you can see. Can you see the Q&A button?
Yes.
Near the chat, there are two questions in English. And one question was in the chat about IFRS for SME. You might know that we, Ukraine and Armenia together submitted our joint comments on this project of IFRS for SME with the help of the World Bank. So, probably the question is about the progress, when to expect the changed standards to appear, and how to see what comments were considered and which were not. And additionally, the question asks that, is it fair to align IFRS for SME to IFRS? Okay. So probably it's a general question.
Yeah.
Yeah, maybe you can address that one.
Yeah.
Thank you.
Let's start with these first, and then I go for the Q&A chat there. SME, the process, how it works, as I said, it was a standard that was issued in 2009. There was a review in 2015, but it wasn't a complete review. There were many standards that were being issued right before. You might remember that IFRS 9, IFRS 10, 11, 12, 15, and then it's not 15 wasn't actually at that time issued, but 9, 10, 11, 12, and 13. And then this review that actually didn't work with that one. And then this second review is a bigger one than was the first review. And then we have this document that we call request for information. And then you said that you have together send I think you said that for Georgia, Ukraine, in Armenia. Yeah, Armenia. Send the comments to us. And what we did, we gathered this information, received many letters from many different jurisdictions. It was very interesting because this project, we clearly see that the profile of those answering was different from the other. For example, if you have a project on IFRS 9 or IFRS 15, but specifically IFRS for SMEs, we got a lot of letters from countries that traditionally are not necessarily issuing letters for the other standards. And I was very happy that I actually got feedback from countries that are really using IFRS for SME and know what are the issues for the small and medium entities. I mean, that what I'm trying to say is that sometimes we get a letter from big jurisdictions, but where IFRS for SME is not actually the main document. And then when we get letters from countries that IFRS for SME is the main document, that's quite important. That really contributes to the process. The staff has already compiled the information gathered, and we have been since October working with the feedback. And you might know that IFRS for SME, you have many sections, because as if each section is covering a standard, let's say IFRS 4 or an area. And then we are covering section by section, including on Friday now we have a meeting that we are going to cover a lot of areas as well. I mean that every meeting we have been deciding, making decisions about each of the sections and how we are going to move with the alignment. What I can tell you, and that it's related to the second part of your question, is that the request for information asked whether we should keep the alignment with IFRS 4. The answer was, general answer was yes. Most of respondents agreed with that. Of course, applying the principles of simplification, faithful representation, and relevance, the three has to be applied, considering the profile of the small and medium entities and the needs from the users. I mean, all these together. That is and now I'm moving to the second part, but it's, as I said, that will take some time until we are able to issue the exposure draft with the final proposals for the amendments of IFRS for SME. Honestly, I think that probably by the end of 2022 is a realistic timetable. We are working hard to do that. As I said, it's a big, despite the name, small and medium, it is a big project. But the question on whether it is fair or not to keep the alignment, first, as I said, we got support from most respondents to do that. Secondly, we are working, we have together with the IFRS for SME, we have a micro entity guidance. Actually, it is based on the 2009 document, but it will be updated for the second review. It actually is exactly IFRS for SME, but in a much more simplified way. It means that if someone applies this macro entity guidance, they will comply with IFRS for SME. It's just a simpler way to work with that. And I can tell you that the ideal is, and we probably will move towards a kind of artificial intelligence, because IFRS for SME is not complicated. What makes, I know that some people may not agree with me, and we are a democracy, and then it's fine. You cannot agree with that, but the point is that what makes the accounting complicated are the transactions that are carried out by the company. If the company doesn't have complicated transactions, it is unlikely that you have to go into some complicated questions or having complicated issues to deal with and then look at the IFRS for SME. And in general, I mean that it is a day-to-day transaction. It shouldn't be complicated to apply that one. We have many academic studies that prove that sometimes the problem with the implementation of IFRS for SME is more related to the level of education, making people aware of what are the main issues, how to account for something, than, for example, the wording in the standard. Again, I came from a jurisdiction that SME is also decided in terms of size of the company, but there are some companies that you have big companies and they fit into the IFRS for SME because they don't have what we call public accountability, but they are still big companies, big corporations. But actually they are SMEs, they can apply IFRS for SMEs because actually they do not have public accountability. And then every time that we ask, for example, shall we remove, just to pick a very good example, shall we remove the guidance on hedge accounting in IFRS for SME? If you ask someone that say that, why do I need hedge accounting? This is for big corporations, but there are some small and medium entities that they apply hedge accounting. They have hedge transactions. That's what I'm trying to say. It's not the standard that makes life complicated. It's the transactions that the company entering into that makes the accounting more complicated. And then we decided, no, we are going to keep the hedge accounting because some companies still make use of it. And that's every time that we make a decision, and we try to avoid including too many things into IFRS for SME because the more you write, the more complex the standard becomes. But the point is that two things that I think that we can focus on. First, we have this document that's going to be updated. That's the micro entity guidance that helps very much to try to make a more simple way of reading the IFRS for SME. And the second one is in relation to jurisdiction working to try to get more educational materials available in their local language, because we have some very good material in our website, but it is in English, it requires subscription, but this is something that probably we have been discussing internally and try to see how we can cope with that. And probably we really need the support of the local national standard setters to make this happen. But basically, I mean that it's not a matter of being fair or not, the alignment. Again, what makes the accounting complicated are the transactions, not the standards, but we are doing something to try to address this one. And thank you very much.
Thank you. Thank you, Tadeu, for this answer. It makes perfect sense to me and hopefully to the audience as well. Can you please also address the questions in Q&A? There are two questions from Anna. Thank you.
Yes, very interesting amendment on amendment regarding covenants. So if this version prevails, as at 31st December, only the attention will be drawn to the fact that a specific covenant is under potential risk of breach, but the underlying liability will not become immediately repayable for liquidity disclosure purpose, right? Yes, actually, I would just add that the liability will not need to be reclassified to current. It can keep as non-current, but actually you will need to change the description of this borrowing. It will need to be segregated to the other borrowings. If you have a borrowing that you have to test in March, it means that before 12 months, you will need to put this in a different line. So you still keep this as non-current, but we'll need to put this in a separate line. The second question, amid ongoing COVID-19, are there any additional requirements regarding financial statements disclosure other than what's already been considered in the 2020 financial statements? Disclosing entities, conditions, and actions taken to mitigate the crisis, and an extra emphasis on liquidity and solvency? That's a very good question, because actually during the COVID crisis, we issued some educational material, trying to identify what are the areas that were most affected. And then, for example, the ECL, that the expected credit loss, the impairment of financial assets, for example, a lot of renegotiations of lease contracts, something that we know that are common issues in the COVID during the pandemic. We issued some educational materials, and our conclusion in general was that the standards, and we should be proud of that, because the standards are principle-based, and they should survive even if we are in moments of stress as we had for the pandemic. And then the point is that it worked well. And all what Anna said in terms of the disclosures, uncertainty, it is already in the standard. And what we can see is that we have this educational material that is available in our website. We have one page just to deal with COVID-19 issues. And we are aware that many national standard setters had issued also local documents drawing attention to the main issues that are related to the pandemic. It will depend very much on the jurisdiction. So you have some follow-up schemes, you have government grants, you have some companies extending the payment terms. I mean, there are a lot of things that the main point is the standard. They have been responding well to all these challenges, and I would recommend checking this educational material in our website and also discussing with some national standards that they have very good documents that they issued locally.
Thank you, Tadeu. The one question is in Georgia. So just to give you some flavor of this question, SARAS has made a lot of, so it made an awareness raising campaign why this reporting is needed and what the benefits of this reporting. But there still are some questions if this reporting is needed and transparency is needed for the small entities and small and medium entities. And the question is asking what the practice in Europe is the reporting of these SME businesses mandatory. And I will answer from my side that this requirement comes from Europe, the association agreement. So Georgia has signed this association agreement and took the liability to promote this transparency and make these reports public. But probably they will be happy to hear from you as well. What's your opinion on this?
That's a very good question, and we can spend our entire day discussing this one. The point is that if you ask, especially the very small entities, what they think about the financial statements, this is not their priority. The priority is complying with tax requirements, preferably pay less tax. I mean, that there are other surviving the business. I mean, there are other concerns if you ask them. But what we are trying to show here is that when we start moving towards not very small, but the small, medium entities, we start to understand that you can access some funding, capital markets. I mean, that it is difficult to run a business. For example, just to give an example of our personal situation, sometimes it's difficult to buy a house. You have to finance, you have to get a mortgage for that one. For a company, it's the same. If a company wants to grow up, it needs usually funds. And it's much easier and cheaper if you have a very good quality of financial statements to present to a financial institution. Not saying that, Tadeu, I still can get some borrowing. I talk to the manager of the bank. You know, we have all this kind of conversation. But the point is that there is many academic studies, and there is a correlation between the development of a country with the quality of the financial reporting of its companies, the transparency. All this helps to keep the capital markets working well in a sustainable way, and you can get cheaper financing. It is really, that's the biggest advantage. And then for those that want to make their business grow, they will realize that having a good set of financial statements is a very important step towards sustainability, even if it is for a small and medium entities. There are plenty of proof, especially from academic studies, having that one. And in Europe, what has happened is that some countries, what they do, they have their they're similar IFRS for SME, but it's a local standard that is issued, and it is in some countries has adopted that one. Just a matter of comparison. In the world, we have something more than 144 countries applying IFRS full, and we have 86 countries applying IFRS for SME. As I said, usually, even if IFRS for SME, people may find it complicated. If it is a small business, the financial statement should be a very simple one. And I can assure you that if you arrive with a good set of financial statements and put on the bank manager table, I think that it will make your conversation much easier, because it does make a big difference. That's the practical answer for that one.
Thank you. Thank you. And maybe one more from Tamar in English in Q&A, and I think we can.
Question regarding common control transactions, okay, business combination of the common control. Can we rely upon the issue discussion paper for transaction accounting related purpose, or will such approach still be challenged? Is the guidance indicated in the discussion paper the only possible accounting way, or are others also acceptable? As I said, we sent the discussion paper for comment. We got this comment, and we did not start discussing the feedback received. But the document was issued already based on a lot of discussion with many, especially regulators, because this is an issue that involves listed companies. It has some tax implications. So if you can see that every single jurisdiction has your own way of see the issue, especially because there isn't any guidance before. And then local jurisdictions start developing their own guidance. And then, of course, they try to say that what would be, so hopefully, the legacy gap become the current gap. There might be some changes, but the basic situation here is that if there is no controlling interest, it is likely that you have the fair value should be provided. Otherwise, the book value, probably in terms of cost-benefit relationship, is the best one. But I still honestly have to look at the feedback received and see whether someone has proposed some other ways of doing with that.
Thank you. Here's the last one. So it's regarding a SPPI test in IFRS 9. Are you comfortable, Tadeu, to go in this detail? So I will read out the question and probably. So this is the question is about SPPI for the companies who have many long-term assets. So, and they are asking that what is the practical way to do this test, and asking for the example if you can provide.
Actually, if it is a current or non-current asset, it doesn't make a big difference. Yeah, I mean that the main point here, and it depends from jurisdiction to jurisdiction, because you may have some financial products that you may look at that and see whether there is something else. But the basic is just looking what is the common practice, because it makes a big difference. For example, if you have some, I remember one discussion about items that are indexed to inflation, for example. Is it considered part of the normal SPPI? In a country that has inflation, yes. But if you just have something like twice the general price index, for example, and then you start to leverage this one, it means that it doesn't meet the SPPI. I mean, that it really, it's difficult to say that what is the issue. They has to look at the example. I can tell you that I had one experience in relation to something that was common practice in one country. And then because it was a common practice in that country, it was considered as SPPI. But if it was applied in other countries, it would not be, because it doesn't reflect what would be for that country, considered just payment of principal and interest. It will depend from jurisdiction to jurisdiction. I definitely would need to understand exactly what is the example that Marian has in mind, and that just to try to understand exactly what is the
so I think the accent is on the disclosures. So she said that there are many disclosures required, like the qualitative and quantitative disclosures. And when the company had the many assets on which it should conduct this PPI test, how should it disclose all this? Maybe the question is that it would be disclosed in aggregate manner or separately, but yeah.
It's definitely on an aggregated basis, especially if you have many. That there is no way to do this on the details, and actually it passed through a internal process. It has to develop some internal process to make the test, because you can't just test instrument by instrument. You have to get some process to get this tested on an aggregated basis. Of course, if there is anyone that is individually material, you have to stop and look at this individually.
So thank you, Tadeu. Thank you. If you would like, we can have the 2-minute break, or we can go straight to the second part of your presentation.
It's up to you. I just have my water here. And
okay.
Unless you think that, would you like 2 minutes for the audience, or before I start?
Let's have a short 2 minutes break, and then let's start this management commentary then to give audience some
20 past.
Rest. Yeah.
Okay.
2 minutes. Like now it's 11. So let's start in 3 minutes, actually.
Okay.
Okay. Great.
I'll be back.
კოლეგებო, მეგობრებო, 3 წუთი შევისვენოთ და გავაგრძელოთ. კიდე დაგვრჩა მოკლე სესია მმართველობის ანგარიშგებაზე. მადლობა. So we are back. Colleagues, ვიწყებთ მეორე და ბოლო სესიას. Tadeu, please, the floor is yours. And we'll have some 10 or 15 minutes at the end for the Q&A as well.
Okay.
Thank you.
Thank you. Just 1 second. Yeah. How can I get rid of this? The chat is appearing for me in front of the slides.
No, so the chat should have the X button. You mean the Q&A chat, yeah?
Yeah.
It's on the right corner. There is an X button. If you click on it, it will disappear.
Okay. Thank you. Sorry
So,
about that.
okay.
Okay. The project, the management project, what we are going to give you is actually an overview of what we have here. The purpose of this part of this presentation is actually a brief overview of this exposure draft on management commentary. If anyone is more interested in this project, you can find the document itself in our website, related documents, snapshots, webinars. There are many webinars that were recorded for this project, and I would really recommend if you will have more interested in the details of this project. Yeah, okay. Let's start discussing what exactly management commentary is. This is a report that complements a company's financial statement. I really like this graph that you have in this slide because it gives you a very good idea what I'm talking about. Sometimes we have this wider report, sometimes then you have the financial statement, and management commentary is a kind of reconcile the information of these two reports, typically provided alongside with financial statements in the company annual report. It might have some different names in jurisdictions. We call management commentary, but sometimes some people call it MD&A, strategic director's report. It is, in the end of the day, a narrative discussion that provides additional information needed to understand, interpret the numbers in the financial statements, and also to assess the company's prospects and management stewardship. Management commentary includes a mix of financial and non-financial information on matters that are key to company's long-term success. A good clarification that we always get this type of question, and how does management commentary compare with other forms of reporting? Basically, narrative reports may be of interest of a range of users, investors, employees, government, general public. Consistent with the IFRS framework, our management commentary, the focus of our exposure draft is on investors and creditors' information needs. So it will not necessarily meet this other users' needs. It's again, and by the way, the sustainability report also, the focus is on investors and creditors' information needs. It doesn't mean that the other stakeholders will not find the report useful, but the focus is on them. And if that is something that's very important to a public, and then I think that sustainability report is a very good example, that to say that if climate is important, it may interfere for the general population. It is likely that it's going to interfere in the company's sustainability, and then it will be interesting for the investors as well. And then in this case, what I'm trying to say here is that despite the primary user, as it is in our IFRS framework, are the investors and creditor information needs, it is likely that the report will be also useful to these other stakeholders as well. And if we also compare with sustainability reporting, that's one of the most common or known fields that we have for wider corporate reporting. as I said, many companies will be affected by sustainability factors, and where that's the case, it's supposed that the management commentary would need to include information on those matters that is material to investors and creditors. And I will elaborate a bit more in the next slides. So why the IASB is doing the project on management commentary and what it's trying to achieve? The original management commentary practice statement was issued in 2010. It's not the IFRS standard, it's an IFRS practice statement. Therefore, it's not exactly part of the necessary standard to be applied to have financial statement in accordance with IFRS. I'll talk about the scope in a slide later on, but basically to segregate this document is not an IFRS standard, it's an IFRS practice statement. Since 2010, when it was issued, a lot has happened. I think that we can divide the reason for reviewing this document into three. The first one is that the narrative reporting has moved since then. We have a lot of frameworks. When I was talking about sustainability report, I said a lot of, we call the letter soups. And then it's something that it's really have developed a lot of things since 2010, including the integration report that is even before 2010, but a lot of new frameworks have developed since then. There is now, let's say, an opportunity to consolidate all these innovations from these frameworks to support what we call the high quality, globally consistent narrative reporting. A second reason, we know that investor information needs are changing. And then if you just look investor information needs 10 years ago and now, they are requesting much more information that they wouldn't request 10 years ago. There is much greater recognition of the importance of long-term prospects in determining a company's enterprise value and ESG, sustainability, all these factors that we all know that just become an entry into the agenda of these investors and creditors. And third reason, there are some well-documented gaps in the current reporting practice. And when we look at some of the current, there are very good management commentary, annual reports, but the point is that for some, we can clearly see sometimes a short-term view. Reports can't address the drivers or long-term prospects, or there is a lack of focus. The reports touch on the right topics, but actually doesn't provide very useful information of them, or the information is fragmented, tells one part of the story, but not the one. Usually is the good part of the story, not the bad one. And then we know that this kind of problem we have today in the annual or management commentary. And if we take those factors together, an overall board management commentary framework was needed. And what is the aiming to achieve? What we are trying to achieve, as it is in the slide, the board has sought to, let's say, consolidate these innovations in narrative report to meet what we said, global capital markets needs, high quality, consistent. That's another very concern, that we have different and fragmented annual reports. And I'm calling annual report, but it's management commentary. And then what we are trying here is to bring some consistency between different jurisdictions. Then therefore, it would be a comprehensive framework, again, with focus on investors and creditors, information needs, and to provide effective basis for preparing useful management commentary. And then if we discuss with management in many countries, sometimes they say that I want to prepare an annual report or management commentary with quality, but sometimes I feel there isn't a framework available. There are many, but all of them are focusing on a different area, but there isn't one that actually is a more generic and consistent, more comprehensive framework on how to prepare a document like this. One thing that is we are trying to make here is a document that's flexible in terms of allowing management to tell their story about the company, what we call through the eyes of management. This story should be centered on what we call key matters that are the fundamental company's issues prospect based on information that management uses day to day to run the business. As well as to provide flexibility, the board aims to provide a rigorous basis for assessing compliance. This could help regulators to mandate the framework in their jurisdiction, and it is also designed to provide an effective basis for auditors to provide external assurance, which could lead to greater trust placed on information in management commentaries. And then if we have a management commentary and there is a kind of assurance provided on this one, it would make a big difference in the future. Another important consideration for the board has been to develop a framework that could be applied alongside local laws and regulations and other narrative reporting requirements. And then in the next slide, I showed how we can understand the role of this management committee. But the most important that each jurisdiction should be able to apply, and it probably would fit into the local legislation. Focal point of connectivity, the board has designed management commentary to bring all the information types together to tell the company's story. And then if you just look at all this information channeled to the management commentary, the financial information plays an important role in understanding the prospect of a company, but investors and creditors also needs not only the financial information, but information on sustainability and other information to understand how the business is managed in terms, for example, environmental impact that could leave it exposed to regulatory or customer actions. And we have the business, how it's progressing in terms of target market, because sometimes we think that sustainability, climate, etc., but sometimes we also want to hear in this management commentary questions about market strategy. I mean, that supply chain nowadays is something that everybody's discussing. All this kind of information should be in the management report. I mean, that again, I really, this slide is interesting because you can see that you are just channeling all the information that would be in just one document to help investors to make decisions. That's exactly what we are trying to achieve here. And the one question that could be happened is whether the sustainability report would be a separate report. Actually, the management commentary, in many cases, if not all, could be the house to receive the sustainability disclosures that the IASB would issue. That I think that if actually this project management committee is a strong candidate to be one of that project that probably there will be a major interaction between the IASB and the IASB. Exactly because of this this aim to try to bring all this information together in a single document. And who would apply the revised practice statement? That's a question. First, as I said, the practice statement is designed to in a way that local lawmakers and regulators could apply it. As this is a practice statement, company again do not need to apply to have the financial statements in accordance with IFRS. It is a separate document. It is down to each country regulator to decide whether to mandate the practice statement or not. They can also decide to update if they have any local requirement or guidance to integrate some of the ideas or the proposals that is in this document. The proposal built on national innovations. I mean that we just not invented this one. It's just feedback that we receive different national standard setters, jurisdictions that provided us with this information. I mentioned a lot of organizations, some new frameworks that were developed in the last years. I mean that all these were considered together when we developed the proposal. And we hope that it should be attractive for regulators in each jurisdiction to do so. Companies also, even if a regulator does not require it, the company may decide to apply it because it's just it is a best practice, transparency. I'm sure that this will be incorporated into the enterprise value when you have this level of transparency. We just discussed about IFRS for SME, how this could help to access capital markets, even simple funds. I mean, that the loan or something like that. This is the same. I mean, that it would have a much more comprehensive level of information about the company, and definitely will be very welcome for anyone that's interested in understand a bit more about the company. They might do so where are faced more specified reporting requirements. For example, if you have the law that might include the requirement to describe the company's business, and I'm just having in my mind here some examples that sometimes you have a country that the regulator says that you have to provide a report that gives you information about the social sustainability and performance and period, but doesn't provide any guidance on how to do that. And this would also be a very good document to be a basis, especially where there isn't any detailed guidance on how to prepare this document. I mean, that even if it doesn't, the regulator does not make an explicit reference to our document, what we believe that is a very comprehensive document. As I said, what we gather information from many other jurisdictions and reports framework available, and that should be a very good guidance for a company applying, especially in countries where there isn't guidance on how to prepare a management commentary. We talked about why the board is doing the project, what this board is aiming to achieve, but let's talk about how the board is going to do that, the proposal itself. As we just explained here, the board set out and developed a framework that's flexible and robust at the same time. Flexible to allow management to tell the story they're looking with their eyes, and robust enough to provide discipline and consistency, and including to be for the regulation purpose and for the audit purpose, if it is possible to provide a level of assurance. To do that, management committee must focus on the key matters, because if we just think about how much information we can include in a management report, management committee, it's a lot of information. The point is that it should focus on what we call key matters that are fundamental to the company's future success. Because these matters are company specific, the board can't provide, let's say, a prescriptive list of disclosures that must be provided by all companies in all cases. This is why the board has adopted an objective-based approach. For those that are familiar, and I discussed this during my IFRS update, it's similar to what we have done in our proposal to revise the disclosure requirement. I mean, that is focusing on objective-based approach instead of a prescriptive list of what you should disclose. At a high level, the board is proposing an overarching objective that has two components. Basically, the first is backward-looking, and the second is forward-looking. The backward-looking to enhance investors' understanding of the financial performance and position reported in the company's financial statements, and the forward-looking to provide insights into the company's ability to create value, generate cash flows. That's basically what investors in credit are very much interested. And to help preparers to identify the information needed to achieve this, the board is proposing a comprehensive set of disclosure objectives for each of the 6 areas of the content that's on the right of this slide. I'll show later an example for each of them, for one of them actually, just to understand. But the board is also proposing requirements and guidance on selecting present information in management commentary. For example, whether information is presented in a balanced way and in an accurate way. I will discuss this later as well. There are some principles in how to include the information in these reports. Coming back to disclosure objective for the content areas, these are the core of the board's proposal, let's say. They are designed to provide the basis for preparers or management.
Tadeu, sorry to interrupt, but to answer your comment or just a statement, we are exactly the country where the law obliges companies to prepare the management commentary, but do not give the precise guidance how to do that. So we have some guidance based on several documents prepared in Georgian, but it's not mandatory. So the companies might choose any guidance which addresses the requirements in the law. So, and one of these is exactly what we are looking now. So what you are presenting, the management commentary guidance from IFRS Foundation.
No, excellent. And one good news as well, that if you want to apply this proposal in phases, you can do that as well, because actually you don't need to comply with the entire document. You can have a partial compliance. That is something that is proposed in the document as well, that is possible to partially comply with that one. And then it just need to be clear where you are complying with, because some companies may decide doing this in more than one phase. You can apply the document as a whole, but it would be perfect for Georgia. And that's the way that we explained it. I mean, that it really provides, it's a really good document. And you would enjoy the appendix as well, because it's a very good summary, because sometimes you may believe that it's a lot of information that needs to be disclosed, but when you think about what we call the key matters, where you should focus on, you believe that actually it's going to downgrade or the level of information, because you don't need to provide a lot of information, but just focus on what is important. And thank you. Just coming back to this slide here, you have the as I said, we are working with the disclosure objective approach. These are the core of our proposal, designed to provide the basis for management to prepare the information, to tell what we call unique story about the company. There are a lot of flexibility in this regard. It's much more just bringing to this document something that they probably are using to run their business. On the slide here, you can see an example of the business model content area. The disclosure objective for each area of content comprise 3 components, as you can see here. It's easier if you just start from the bottom here, specific disclosure, describe the specific investors' information needs in relation to the areas of content. Essentially, they tell preparers what would be the broad topics information that should be covered. For example, just taking one area of content that is the business model that is in this slide, this information for a specific objective would need to cover the range, nature, and scale of the company's operation, the cycle of creating value, generating cash flow, environmental, social impacts, and etc. When we move to the assessment objectives, describe the assessment that rely on the information provided for the area of content. Essentially, they will tell the preparers why information is needed to help preparers to identify what would be material to be disclosed. And then for business model, again, as an example, how effective the company's business model is, how scalable and adaptable it is, how resilient and durable this is. And finally, we have the headline objective, describes the overall objective information needs in relation to the area of contents. And it's a kind of test of success. It's a kind of overarching disclosure objective. It is there for the preparers, and actually I would say for regulators and auditors as well, to step back and consider whether the information that is being provided is complete. There isn't anything that's missing. The headline objective for this area of content of business, for example, is here, how the company's business model creates value and generate cash flow. Basically this one, are you answering this disclosure objective? When you look at what we have included based on the assessment objective and specific objective, it's supposed that automatically you would meet the headline objective, but you still have this, let's say, final test to be sure that you have this information there. And if you go to chapter 11 of the exposure draft, it provides an overview of all disclosure objectives for all areas of content in one place. It's like a big table that helps very much to give you a very clear idea at a glance. Materiality and focus on key matters, as I said, may look at disclosure objective, ask for a lot of information, but again, it was designed for preparers focusing on what is the most important, what are the key information for the company. Again, the board's intention is to ask preparers to provide all information they have, but only on what would be the key matters. We know that we have to do some judgment because what is key matter, because what is material. And then we know that making materiality judgment assessments for management commentary can be challenging. It is for financial statement, for management commentary, it will be as well. And then what we are proposing in this document, requirements and guidance to help preparers identify what would be considered as a material information. Then we introduced the notion of key matters, as I said, the requirement to focus on them. And these are matters that are fundamental for a company's ability to create value and generate cash flow. It sounds like very simple, but basically, does it actually sustain, create value, generate cash flow? If yes, it's likely to be a key matter. Just looking at the perspective of the company in the long term. So again, these are matters that the company's future success rests on. They are likely to be ones that management is already monitoring and managing, and they are likely to be pervasive and relate to more than one area of content in that slide that I showed, the 6 areas. In addition to the guidance on key matters, the board is proposing other guidance to help preparers to make materiality judgment. For example, it includes assessing whether information about uncertain future events will be material. Another example, we know that information needs to be presented at the right level of detail to be useful, and we are proposing guidance to help preparers to determine the most appropriate level of aggregation. I talk about key matters being pervasive across the content areas, so the information needs to be presented in a coherently way to address the company's ability to create value and generate cash flows. On this slide, you can see how those content areas fit together. Business model is about the company is doing today, its current ability to create value and generate cash flow. Strategies about how management plans to sustain and develop the business model, the future, including long-term. Information on the company's key resources and relationship is needed to understand what the company's business model and strategy depends on. Risks address the matters that could disrupt the direction in which the company is going to, what could disrupt its business model, strategy, resources and relationships, and external environments about what has affected or could affect all these areas together. And finally, financial performance and position is about understanding how all these factors translated into the company's financial statements. Long-term prospects, intangible, and ESG. You may have noticed that when you read the document, you don't have a separate area of content for matters that have been in the media, let's say something fashion, long-term prospects, intangible, ESG, sustainability. We are aware how this is important about this matter for investors, and these all we're considering in our documents, as these matters are pervasive and can affect companies in various ways. Rather than addressing them in isolation, requirements and guidance for reporting on these matters are provided throughout the exposure draft. And then if you just look at this, you can understand actually it is there. The board provided just because actually when we are drafting the document, people are, okay, but yes, but I would like to see this more clearly. And then the board, what has decided is to provide an appendix summarizing how its requirements and guidance included throughout the exposure draft. might apply to all these methods. This serves as both a tool to help preparers to identify topic-specific information that should be included, and it's also intended to set expectation on the scope of information required in a management commentary. Moving to the rest of the IASB proposal, let's talk about selecting, presenting information. The board's proposed requirements that would apply to all information in the management commentary. It should possess what we call the attributes of useful information. The top 6 attributes listed on this slide, just materiality will be familiar to many of you, though in some cases we have used simplified terminology, but these 6 attributes is also widely used in narrative report and also present in our conceptual framework for financial reporting. Therefore, it is equally applicable to financial statements. The requirements and guidance on the attributes of useful information included in the exposure draft are designed to address the practical challenges that arise in preparing management commentary. Just to give you an example, I talk about the current gap in the reporting practice when management focuses on what is positive news only. What the board is proposing is requirement and guidance for ensuring that the information management commentary is well balanced. The requirements would apply to management commentary as a whole, so that all key matters has to be included. Whether it affects the company positively or negatively, it has to be discussed, and the information also, each matter within the management commentary should be well balanced. In addition to the attributes based on the conceptual framework, the board proposed an attribute that is particularly important for management commentary, that is the coherence, because we know that there are sometimes some critics that if you look at the annual report, and again, I'll just use a generic name here. If you look at the annual report, it's much more optimistic than, for example, the financial statements. And then you can realize that there isn't a coherence between the 2 documents. And then we are stressing this, that it has to be coherent with any other document outside the management commentary. Just an example, the financial statement, it has to be coherent. And it needs to be coherent also inside the document itself. I mean, that sometimes you have, for example, a key external factor that is identified, and the coherence would mean that the information about the company's business model, for example, should enable readers to understand the parts of the business model that are exposed to this factor, and the company would also need to explain how management is responding to this factor. The point is here that sometimes an information may be included in management report, but actually there isn't any other action in terms of, yes, but you have a risk, but what are you doing? How it interacts with the business model. Therefore, the information that is included in management commentary is not only coherent in relation to the documents that are in the surrounding the management commentary, but within the document as well. I mean, that you can't have a loose information. It has to be all linked and has to be well covered. Let's look now at the requirements and guidance on metrics. You may have noticed that we don't have a separate metrics area of content, but that's because material information about each of areas of the content will often include metrics. Metrics may need to understand the potential implications of the key matters. They may also be needed to understand the progress made in managing those matters. And the metrics each company needs to include in its management commentary will depend on its particular circumstance. They would be company specific and based on probably those used by management to run the business in their day-to-day. The exposure draft provides example of metrics that may need to be included in management commentary, but as I said, it is likely that it will be based on the way that management is running the business. On this slide here, we show how metrics may be used in discussing the company's business model. Our proposal will include specific requirements over the clarity, accuracy, comparability, and coherence of these metrics. Basically, to explain how these works and why this is important. And I hope that this overview of the management commentary was useful. As I said, there are a lot of documents in our website explaining this document. The document is a very comprehensive one, and I encourage you to look at the material that is there as well. There are some webinars, some specific topics if you are interested. The deadline for the comments actually is next Tuesday. Hopefully we are going to get letters, comments from you. And with that, I finish my presentation. I let myself available for comments or questions that you might have on this document. Thank you, David.
Thank you, Tadeu. Thank you for this presentation. It seems like we have a couple of questions in the Q&A. Let's address them straight away, if you don't mind.
Yeah. Starting abbreviating with ESG, as in the proposal of the CSRD, and thus all three pillars, environmental, societal, and governance issues jointly. Why is then we see the only first two of them on the slide? Very good. For example, 46, 49, and also in between. Why is their governance part dropped on how and where would it fit? Would you put an equal or rather unequal importance weights on them? That's a very good question. I mean, that definitely the E and the S are more in the sustainability report, but that it doesn't mean that the governance will not be included in the document. It should be included, but you are right. I mean, this is not the focus on, but definitely this is something that should be included as part of the creation of the value generated of the cash flow, the way that the company is running. What I would suggest you, because this is not the first time that I heard this kind of comment, is just if you are able to issue a letter, even if it's just to include this issue, whether you believe that governance should be also included in the document. It is included in the document, but definitely the weight that is being given to that one is much smaller than, for example, in relation to the environmental and social issues. You are completely right in your comment, but again, it's just because it is not exactly the focus on. But if stakeholders believe that we should do that, maybe we probably try to give some additional guidance. It is there, but definitely not as much as for environmental and social issues.
Thank you. Thank you, Tadeu. Hope it makes sense for the irregular. I think this question can be addressed directly to a regular, so this Georgian one. So I think we are done with questions. We are done with presentation. Let's give 1 more minute for them to like reconcile their mind. Maybe more questions will follow. I will use this pause to thank again our supporters, the World Bank. I see Irina is raising hand, so maybe she will tell us something.
Thank you, David. I don't know, can you hear me?
Yeah,
yes.
We can hear.
Excellent, thank you. Well, I do have a question, actually, if I may. I was wondering if the EU directive requirements that has been already introduced into the countries and also Georgia regarding the management reporting have been considered in terms of the management commentary for the upcoming sustainability reporting, and also the directives on the non-financial information.
No, thank you. Excellent question. I mean that many countries have already developed their own requirements in terms of sustainability management commentary, and we are aware of it. And we can't simply, every time that someone is issuing something here or there, just stop the project. But we are aware of it, and we hope that in the future there will be a kind of at least using the document as part of the document that will be applied in Europe, for example. I said during my presentation that this project management commentary, when we started that one, and all these initiatives from the trustees for creating this new board, the IASB, we just think that shall we stop the project? Because actually there is it's not clear, is management commentary part of the IASB role, or actually this is IASB role? And then we decided that it is our role, but it is like that there will be a strong interaction with the IASB, and whether the countries will include this document as part of their literature or requirements, it will depend of each country. As I said, it's IFRS practice statement. You don't need to apply the document, but you can use this document. You can apply the document as a whole. And then it's the same for Europe. We hope that, and we have been working together with, especially IFRAG, to try to accommodate all the needs and requirements within the document. But the most important is that what we are trying to bring is consistent, because if each jurisdiction starting have their own ways of looking at different subjects, we are not going to achieve exactly what we are proposing with the IASB. And for management committee is the same. I mean, that if everybody's starting just looking how IFRS is working today, how good it was to have just one set of consistent accounting principles, and then we just need this also for management commentary and for sustainability report. And that it is something that we are working on it. We know that the European Union directive is not only in relation to the management commentary, it also affects our sustainability report project. But it's something that we just think that in the end of the day, there will be a consistency between all these different jurisdictions towards a single document, or very close to the single document, hopefully.
Thank you, Tadeu, for your answer and for your very informative and interesting presentation today on behalf of the World Bank.
Thank you, Irina.
Thank you, colleagues, for this conversation. So with that, I think the questions are done and present. Oh, so one more question popped up, maybe. Oh, it's about IFRS. Can you see that? About
if there is any restrictions on refund of VAT under the lease agreement based on IFRS 16 for the lease, and from when it will be into force? What's the expectation of state bodies in this regard, so that being compliance with the above mentioned change in this standard? Actually, I haven't touched on this on my presentation, but there is the issue of the VAT on the IFRS 16. This is something that is not only this issue, but for example, discounting rate, and there are other application questions that are arising from the application of IFRS 16 that was in 2019. And what we are doing, we have been collecting all these questions that are coming to us, and probably it will be used in our post-implementation review of IFRS 16 to address whether there is any need for additional guidance or any change to these standards to try to accommodate or to deal with this type of situation. But this is something that we are aware. As I said, the question of the VAT should be included or not when this is recovered. You can recover. The question of the income tax, the discount rate to be used, all these, we know that it was implemented. It was just 2019, and we are aware of these issues. And as I said, it will be part of the process of the post-implementation review.
Thank you. So we are receiving gratitudes in the chat and some good wishes. And with that, thank you, Tadeu, again for this great presentation, and thanks the World Bank for giving us this opportunity. And thank for all attendees for the good questions and just participating. Thank you.